Welcome to Talk Tickers, where your intelligence briefing on the earnings calls that are really moving the markets. Today, we are doing a deep dive into Box Inc. The results for their Q3 fiscal year 2026, they dropped just after the market closed on December 2nd.
Yeah, and what we're looking at here is, well, it's a classic case of the market just getting confused, right? Box's management is pushing this huge strategic pivot. They want to be the AI-powered intelligent content management platform.
Right.
But the immediate reaction from the street was, cautious at best, pretty negative at worst. So our mission today is to really dig into the numbers, the narrative, and figure out why investors got so hung up on some short-term profitability noise and maybe overlook some, I'd say, genuinely healthy signs and a really compelling AI roadmap.
Okay, let's do it. Let's unpack this, starting with that top-line snapshot.
Right.
Revenue for the quarter landed at $301.1 million. That was a small beat. Consensus was looking for something around 298, maybe 299 million. So this works out to 9% year-over-year growth. 8% if you strip out currency effects. Solid, but, not exactly setting the world on fire.
And see, the problem wasn't the top line. The problem was all about perception, and it was driven by the bottom line. Non-GAAP earnings per share, or EPS, came in at 31 cents.
And the street was looking for 32?
Exactly. It missed consensus of about 32 cents. Now, that 1 cent miss, that's bad enough on its own, but the context is what really made it kind of deadly here. That 31 cents was a 31% decline year over year.
Wow.
Yeah, from 45 cents in the same quarter last year.
A 31% drop in non-GAAP EPS. I mean, that's the kind of headline that just makes the algorithm sell, doesn't it? Regardless of the details. So what was the main reason for that huge earnings compression?
It really came down to this sort of technical accounting bomb, a non-cash deferred tax expense. Management was very clear on the call. This decline was almost entirely because of this new charge. It was about a 16-cent headwind. Last year, it was only about a penny.
Okay.
So if you just strip that non-cash item out, the operating earnings picture, it looks fundamentally different.
But help us and the listeners understand this because it seems counterintuitive. How does becoming more financially healthy, which is their goal, suddenly lead to a giant tax expense that just crushes the EPS number?
That is the absolute critical question, and it's confusing. This expense is actually a signal that the company is finally sustainably GAAP profitable. See, in past years, because they weren't consistently profitable on a GAAP basis, they had to keep what's called a valuation allowance against their deferred tax assets.
So they were basically saying, we might not make enough profit to even use these tax breaks.
Exactly. It's like a rainy day fund for future losses that they now realize they just don't need anymore. So when they release that allowance, which signals they're very confident in future profits, boom, this non-cash expense hits the earnings for the current quarter. And it's important to remember, no actual cash is leaving the company.
So it's a positive sign for the business structure that just looks terrible as a short-term headline. The market sees a 31% drop, but management sees proof they're now a grown-up, profitable company.
That's the perception gap. A textbook case of headline noise just drowning out the fundamental story.
Okay, that's a perfect pivot then. Let's shift gears and look at the things management actually wants us to see. The leading indicators, the operational metrics that are supposed to tell the future story. Were they strong enough to offset this accounting mess?
Oh, absolutely. The forward-looking metrics, they were the best part of the whole report, easily. Remaining performance obligations, RPO. That's the value of all the signed contracts they haven't billed for yet. It hit $1.5 billion.
1.5 billion.
Yeah, that's up 18% year over year, 19% in constant currency.
18% RPO growth when current revenue is only growing at 9%. That's a huge gap. Does that just confirm they're executing, or is there some kind of friction getting those deals recognized as revenue?
It confirms execution, but it also just highlights a natural lag. And if you break down the RPO, it gets even more interesting. Short-term RPO was up 14%, but long-term RPO, it jumped 25%.
A full 25%.
That tells you customers aren't just buying more, they're signing longer multi-year deals. That's a huge vote of confidence in the platform, especially from those regulated industries they're targeting.
And billings kept pace too, right? They came in at $296 million, up 12%. That was better than their own guidance. So the sales engine is clearly working.
Correct. And they did all this while maintaining a really, really strong margin profile. Non-GAAP gross margin was steady, super high at 81.7%.
Wow.
And non-GAAP operating margin was 28.6%. It dipped a tiny bit, like 50 basis points, which is nothing given the tax stuff and the investments they're making.
Right.
So underneath all the complexity, you still have a very high-quality software business.
And even net retention rate, which is a key health metric for any SaaS company, that improved. It hit 104%, beating the 103 expectation. What's behind that? Is it just people buying more storage?
It's more sophisticated than that. Management was specific. The NRR bump came from two things. Yes, classic seat expansion, but also a higher price per seat.
Yeah.
That directly confirms that their new Enterprise Advanced Bundle strategy is working. They are successfully upselling customers to more expensive, higher value tiers.
And those tiers include the new AI and security features.
Precisely.
So connecting all the strength back to the balance sheet, This is a business that generates a lot of cash, right?
Oh, extremely cash generative. Operating cash flow was strong at $73 million, up 17% year over year. Non-GAAP free cash flow was over $61 million. And they're using that cash very aggressively to manage their capital structure.
Yeah, I noticed they were buying back a lot of stock.
A lot. They bought back 2.4 million shares for about $77 million in Q3 alone. And the board just gave them another $150 million for more buybacks.
And the debt.
Even more telling. They have $205 million in 0% convertible notes due in January. They plan to pay that off entirely in cash. No new shares.
Which is a huge vote of confidence.
Massive. It basically says, we had the cash, and we don't think you'll see our stock diluted unless it rips past $35.58.
Okay, this is where it gets really interesting for me. We're moving beyond the numbers and into the core strategy, their identity.
Yeah.
Box is trying so hard to stop being seen as just a fancy Dropbox, a cloud storage utility. They want to be the neutral AI content hub.
That phrase is everything. That is the entire future of the company wrapped up in a narrative. The thesis is simple. Any AI agent, whether it's from Salesforce, Google, OpenAI, whoever, it's only as good as the data it can securely access.
Right. Garbage in, garbage out.
Exactly. Box wants to be that secure, governed, single source of truth for all of a company's unstructured data. The foundation that all those other AI tools have to build on top of.
So they're the essential plumbing underneath all the cool, flashy AI features. And to make money from that, they've launched this new suite of agentic products. What does agentic even mean in this context?
Yeah, that's jargon we need to break down. When they say agentic, they mean the AI isn't just analyzing your document and spitting out a summary. It's taking action.
Okay.
It's orchestrating a process based on what it finds. It moves the platform from just being a passive hard drive in the sky to being an active participant in your workflow.
Give me some of the specifics. What are these new agentic tools?
Okay, so there were three big ones they highlighted. First up, you have Box Extract. This is an AI agent designed specifically to pull structured data out of messy, unstructured documents. Think about invoices, contracts, medical records.
So instead of a person reading a contract, the AI reads it and pulls out the key terms.
Exactly. It turns Box from a simple storage utility into a mission-critical tool for process automation.
And that would feed right into their next product, Automate.
Precisely.
Yeah.
The second pillar is Box Automate. This is the workflow engine. It can orchestrate processes not just inside Box, but with other third-party apps. So, for example, Extract pulls a termination clause from a contract, and Automate then automatically sends that contract to the legal department for review. No human has to touch it.
And of course, security is getting the same AI treatment.
It has to, especially for their target customers in finance and government. So they launched Box Shield Pro. It's a new AI-powered security tier that can automatically classify sensitive data and actively hunt for threats, like ransomware patterns. This is a huge justification for the higher price point of that enterprise bundle we mentioned.
And they're not picking winners in the AI race, they're integrating everyone.
Totally neutral. It's their big advantage.
Yeah.
They mentioned Mistral, Anthropic's new Claude, Google's Gemini 3, the latest from OpenAI. And beyond that, they have a big multi-year deal with AWS and a partnership with TCS. All of this is designed to help customers with what they call legacy takeout.
Legacy takeout. Let's dig into that because it sounds like a massive growth opportunity.
It's probably the biggest. Legacy takeout is just a fancy term for getting companies to finally ditch their ancient, clunky, 20-year-old enterprise content management system.
The old ECMs that can't connect to any modern AI.
You got it. And management confirmed on the call that the promise of AI tools like Extract and Automate is finally giving customers a compelling reason to go through the pain of migrating all that old data on a Box. This is how they stop competing with other cloud storage guys and start competing for these enormous multi-million-dollar corporate libraries.
If the product is strong, the strategy is aggressive, the leading indicators like RPO and NRR are all pointing up,
Yeah.
we have to come back to it. Why did the market hate the report? Let's talk about the guidance.
Right, the guidance, when you combine it with those messy profitability optics, it created this negative feedback loop. For Q4, they guided revenue to about $304 million. That was a little shy of what the street wanted. But the real kick in the teeth was the EPS guidance, about 33 cents. That was below expectations. And again, they blamed those persistent non-cash tax and currency headwinds.
And the full year picture didn't look much better.
No. Full-year revenue guidance of $1.175 billion was fine. It was in line. But the full-year EPS guide of about $1.28, that was a slight guide down from what the street was modeling. And in this market, which is obsessed with clean numbers and accelerating growth, even a 1 or 2 cent guide down gets absolutely punished.
That context is so important. Box has been a huge underperformer. The S&P 500 is up, low 20s over the last year. Box is down about 14%.
Yeah, and they're competing for investor dollars against these high-growth AI names that are showing clean, immediate revenue acceleration. So the market saw the soft guide, saw that scary headline EPS drop, and just sold. The stock dropped between 5 and, I think, 11.5% right after the call.
Choosing to ignore the 18% RPO growth.
Totally ignoring it. They focused on the near-term fear instead of the long-term strategic clarity. It's a total disconnect.
The ultimate disconnect. Operational strength versus optical weakness.
Exactly. I mean, they're doing everything a high-quality SaaS company should do. High retention, generating tons of cash. They have a clear path to real GAAP profitability. But the market right now is just refusing to look past the accounting noise. It's demanding proof that the AI strategy can turn into faster than 9% growth right now.
Which brings us to our final segment. This is not financial advice. We've looked at the numbers, the story, the market's fearful reaction. So the question is, given this giant gap between the fundamentals and the stock price, what's the outrageous but plausible trade a hedge fund analyst would be pitching right now?
And we have to say it. This is for informational and entertainment purposes only.
Yeah.
It is absolutely not financial advice. We're just analyzing the dynamics here.
Duly noted. Pitch the trade.
Okay. The trade is what I'm calling the January conversion catalyst trade. The premise is simple. The market has fundamentally mispriced this stock because it's fixated on a temporary non-cash accounting issue. The underlying business is healthy. The 18% RPO growth and the NRR acceleration prove that.
So how do you structure the bet?
You go long the stock, just buy BACA shares. You're betting that reported EPS normalizes once this tax issue is in the rearview mirror. And you're betting that growth accelerates toward their 10 to 15% long-term target, driven by these new AI bundles. But the key, the short-term catalyst, is that debt structure we talked about.
You're using that January 2026 convertible note maturity as the trigger.
Yes. You pair the long stock position with buying some call options, and you target a strike price right near that capped call price of $35.58. We know management is paying off that $205 million in cash. So we are betting that their aggressive buyback program, plus a few AI strategy wins, creates a floor under the stock and makes that $35.58 price a magnet as we get closer to January.
It's a bet on the balance sheet and the strategy winning out over the headline noise.
It's a bet that strategy ultimately trumps accounting optics.
A really compelling argument. So to wrap up this deep dive, Box is moving fast, trying to become this essential content layer for the entire AI industry, and it's backed up by some really strong leading indicators like that accelerating RPO. But the market, which has a very short attention span, just hammered the stock because of an EPS decline that was mostly an accounting fiction and, ironically, a long-term sign of financial health.
Right. And that leaves us with this final thought for you, the listener. Box is betting its future on these new features like extract and automate, but right now growth is at 9%. So the question is, how quickly do these new agentic products have to get adopted and start making real money to push that growth rate back into the low double digits and prove that management's bullish vision is actually a reality? That's the number we'll be watching for next quarter.
Something to think about. Thank you for joining us for this analysis. We look forward to continuing your learning journey with you soon. And remember, all the content we discussed is purely a reflection of the source material provided.